Hello, I'm Rick Underwood, and this is David Walterman. We're with the Reverse Mortgage Group. Today's question is, can you use a reverse mortgage for anything?
I love this question and I love this answer because we're going to talk about a couple that wants to use a reverse mortgage just to travel.
Sure.
And you know what? It's okay.
Oh, yeah.
So this couple, they've lived a modest life. They've put a couple kids through school. They've been diligent.
Paid off their home.
Paid off their home. They're in their 70s and they're thinking it's time to live a little bit. And we just want to travel. So in their case, they didn't have savings set aside to do this.
Sure.
So they're looking at ways to fund their travel adventures. One of the ways you can do that if you own a home is through a home equity line of credit, HELOC.
Sure.
They're looking at that option, but then they realize, well, gosh, that's going to create an unwanted monthly payment.
Exactly. You're going to have a mortgage payment there, and the bank can freeze those. Exactly.
Process.
Exactly. So, enter reverse mortgage.
Reverse mortgage. Explain what a reverse mortgage is.
So a reverse mortgage is an ingenious way to tap into the equity in your home without making a mortgage payment. Really simple.
And I love the word ingenious because it really is.
It really is. And for most people, when we explain it to them, they think, wow, I didn't know such a thing existed. This is amazing. I can use the equity and draw out cash. I could cash out refinance without incurring a mortgage payment.
Sign me up. So how do you sign up? Like, what are the qualifications?
Exactly. Wow. Okay. So with that, very easy to qualify for a reverse mortgage. Okay. You just need to be 62 years or older.
They are.
You need to live in your home.
They do.
And you need to have equity in your home.
They do.
That's it. That's it. I mean, it really is that simple. The underwriters are not concerned about income or assets or...
And why is that?
Credit score even, because the mortgage itself is only secured by the property. They're not qualifying you, they're qualifying the property because you're not making a mortgage payment. They're going to use the equity in the home.
The bank still wants to see that they've got enough money coming in to pay their property taxes, homeowner's insurance, just like on any other loan.
Just like any other conventional mortgage.
Other than that, it's that simple.
It's really that simple. It really is. Yeah.
So in their case, they have grand plans of maybe a trip to Europe, maybe a cruise. They have a plan in 2 years to take the entire family to Hawaii.
Which is awesome.
And I love this because the kids are supportive.
Oh, yeah.
They've recognized the sacrifice over the years. And so they're standing by, cheering mom and dad on, saying go.
Yes, because every once in a while when we do a reverse mortgage and talk to the kids think, gosh, I don't know. I kind of want mom and dad's nest egg.
Yeah.
Which... a whole different conversation. But with this, the kids are excited. They're thinking, we've gone through school, we're on our way, we have kids. You know what I mean? Yeah. Like, no, mom and dad,
we're doing fine in life.
Exactly.
So I love this. So we're going to look at what the numbers actually will produce in their case, because there's a few factors that go into determining how much money is accessible to the homeowner, and it's age and the home value and zip code.
Right. So as much as it's easy to qualify, it's very specific. Right. Once we plug in these figures, these scenario, the calculator is going to tell us exactly what the underwriter will approve them for.
So in their case, they are 74 years young. They own a home in Whittier, which is Los Angeles County, and their home is worth $961,000. And like we mentioned earlier, they have no mortgage balance. It's paid off. So when we plugged those numbers into the calculator, it's giving them what's called a principal limit, which is the maximum amount that the bank is giving them access to, $379,595.
And it's a very specific amount. When we plug in the figures, it's going to tell them exactly the amount that they will allow them to borrow. Yes.
So in their case, let's just call it 380, but it is $379,595. So you illustrate this in a beautiful way to show how a reverse mortgage works. Since they aren't making that mortgage payment, a lot of people scratch their head and go, okay, how does this work?
Yeah, I don't know if anyone's described it as beautiful, but yes.
I just did. It's very beautiful.
So I think the best way to illustrate a reverse mortgage and the figures and how they work out is with a house. So remind me again. Right there.
961.
Value 961.
Yep. And then the bank is giving them access to $379,595. That's their principal limit.
I'm going to say 395. It's 379.
Great.
Okay. So the value of the home is 961. Basically, the underwriters are going to say, okay, based upon this scenario of that amount, we're going to let them borrow 379,000.
Right.
So that's how much they have access to. First question people ask most times is, okay, how does this work? How are they able to borrow this much money without making a mortgage payment?
Right.
Because normally on a conventional mortgage, they're going to give you that much, and then every single month you're going to write a check and you're going to pay down that mortgage balance only to have equity in a home that you can't tap into and everything. So in this case, they're going to let you borrow $379 without making a mortgage payment. I may say that a few times because it's a big deal.
That's worth repeating.
It is. So $379 based upon that value. So on a reverse mortgage, instead of on a conventional loan paying down the mortgage, on a reverse mortgage, what the bank does is they assume a little bit of your equity every month, because you're not making a mortgage payment. So they're going to use a little bit of that equity and they're going to make an interest-only payment, or let's say assumption of your equity, and that's how that works. Second question a lot of people ask is, okay, well, what happens to all this here with all this equity that I had left in the bank?
Yeah.
Well, the underwriters want that left so that you have plenty of equity left to service that loan.
Right.
With that, all that equity is yours. If you were to sell, refinance, or whatever it is on day one at 379, if you took all that out, you get all that equity.
You still own the home.
Still own the home.
You pass on the equity to your heirs.
Exactly.
It's worth mentioning too, this appreciating asset of $961,000 is growing and appreciating year after year after year.
Because you're still in the home. You still own the home. So your home is still appreciating.
And typically, the way they structure these loans, typically the home value is outpacing the loan. And another important thing, this is how much they would give access to, but in this case, they only needed $50,000 at close. So that's that amount. Right.
And that's a good thing to bring up, because the bank's going to give them access to that much, but just like any other line of credit, they can draw a much smaller amount initially. So they only want $50,000 because just like any other line of credit, you don't want to pay interest on money that you're not using.
And you say line of credit, so I like this feature of a reverse mortgage. So they needed the $50,000, they took the $50,000. So let's talk about this line of credit. After the $50,000 and the closing costs, they're going to be left with this growing and compounding line of credit. So let's map that out and see what that looks like over time.
Sure. And to explain that, you're right. They're taking $50,000. Initially, the lender was giving them access to $379,000. It's an FHA loan, so there are closing costs. There's mortgage insurance. So after they take out the $50,000, let me clean this up a little bit. So tell me initially,
their line of credit is going to start at $298,765.
I'm going to round these up, or round these.
Okay, $299. Let's say $299. Okay. Sorry,
$299. Okay.
And guess what? In year 4, they're going to make do on that crazy notion of buying an RV,
right?
Because there's nothing more exhilarating.
Let me interrupt quickly. Just on this, they gave them access to $379,000.
Right.
They took out $50,000. They had closing costs, mortgage insurance, which on an FHA loan, mortgage insurance, that's what gives you all the protections of this loan. So that line of credit after they took the $50,000 and all that is the $299,000.
Yes.
So that's that growing line of credit that's remaining.
And it's growing and compounding at the same rate as the loan.
Yes, as the interest on the loan.
That's very powerful.
So initially $299,000.
$299,000.
Okay.
And we're saying that in year 4, they're making do on that crazy adventurous idea to buy that RV, because there's nothing more exhilarating when you're in your late 70s to get behind the wheel of a 30, 40-foot vehicle.
Wise? I don't know, but yes. Yeah. And, why not? Why not,
go out and live a little bit.
Exactly. Until you hit a toll booth and they take away your license. But
before they take your license away, go get that RV.
Yes.
So in year 4 is when they've decided to do this, and lo and behold, their line of credit has grown to $413,372.
Wow. What was that amount?
$413,000. So they can definitely afford to pull out the $200,000, buy their RV.
Right. So I did these reverse, but exactly. Okay. So after the $299 is grown to a line of credit balance of available $413, they took out $200,000. So then it's going to leave them with, after that, what does it leave them with, roughly?
Year 5, then about $231,000. That's definitely enough to buy postcards from all over the United States and send them to their kids and loved ones.
Exactly. Yep. Every road stop they can buy a Slurpee and exactly. So and if you're doing the math at home, these figures they're not going to add up total exactly because they're accruing, or I'm sorry, the loan balance, the line of credit is growing.
Right.
So these numbers may not match out because after a few months, that line of credit, what they have available, is even higher. So trust us, this is the math.
So let's look out 10 years.
So even after taking out the $200,000, they still have a line of credit of $231,000 because that line of credit has grown.
Yep. And by this time, they've taken their trip to Europe. They've done the full family to Hawaii.
Right. They've taken the $50,000 and the $200,000, and they're still left with $231,000 because it's growing. So you were going to project it out even further, right?
Let's say in 10 years, they're done traveling, and now they think, let's make some home modifications to our house because we want to age in place. We want to live there. At year 10, they've got access to $347,000.
What was that amount?
$347,000. And the beautiful part about this line of credit, it's like having liquid cash. You make the request, and the money is yours.
Oh, it's that simple. For whatever you want to use it for.
Yep.
I mean, like we're saying, travel, buy a motorhome, whatever it is.
You're not making a mortgage payment.
Yeah, which is critical. So they started, the initial amount the bank was going to allow them to borrow was what again? I know I keep jumping around on you.
$379,000.
$379,000. Yep. So even after taking $50,000 and $200,000, after 10 years, they still have a line of credit of $347,000.
And I might add that their home that started out with a $961 is now valued at $1.422, $1,422,000.
What was it again?
$1,422,000.
Trust me, that says $1 million.
So their equity position is still strong.
Right. So even after tapping into all that equity
and living their life,
buying a motorhome, doing all this stuff, having access to this, to the remodel of the house, which would then even increase the value of the home even greater.
Yeah.
With that being the case, when they pass or sell or whatever it is, the kids, the heirs, they still have this home. They still own this home.
Exactly.
So whatever equity is still left because the value has grown, I mean, it's kind of a no-brainer for someone who wants to use the equity in their home and not incur a mortgage payment.
The moral of this story is go out and live your life.
True.
You know, if you've got the equity in your home, leverage it, use it, and live your life.
Because otherwise it's doing you no good.
Yeah.
And it's just sitting. I use the example. It's kind of like having that equity or that cash buried underneath your home that you can't access unless you borrow it. And another great phrase to use is, if you have the ability, if you have all this equity, and let's say you have grandkids that, they want to go to college, pay for a wedding, whatever it is, do your giving while you're living. Use that equity because once you pass, you can't, unless you're looking down, you can't really see them enjoying it. Yeah. So use that equity now.
So we're here with the Reverse Mortgage Group, and we'd love to answer your questions. We can plug in your specific numbers and tell you exactly how much you would have access to and set you up on a plan for your own adventures.
Right. And as we say, to see if a reverse mortgage is right for you.
Right.
Exactly. So until next time,
we'll see you.